Welcome to the Chart Pattern series. In this series, we'll be learning about how to identify and trade off technical analysis patterns. For those who are unfamiliar with stock patterns, these are patterns that form on a chart as a result of moving market prices, which in turn produce a series of highs and lows. And these highs and lows are the building blocks to nearly all chart patterns. Now, these patterns are frequently used as the foundation for technical analysis trading, and they give you an important insight into the price movement of equities and the traders that drive it. They also assist traders in executing predictable and well-managed trades. Now, before I go any further, it's important to know that the technical analysis patterns apply to all markets, including cryptocurrency, forex, stock market, bond market, etc. However, in these courses, I'll mostly be speaking about the stock market because that's what I mainly trade. Now, these patterns come in three different types. First up, we have our continuation patterns. These are patterns that form as a resting period before the stock continues its prevailing trend, either continuing the uptrend or the downtrend it was on. Then we have our reversal patterns. These patterns signify a time when the buyers or the sellers are exhausted and the prevailing trend is out of steam and the stock may head in the opposite direction. Consider these patterns to be a resting period before the market decides that, hey, the current trend is done and a move to the opposite way should occur. And finally, we have our bilateral patterns, which are a combination of reversal and continuation patterns, and they provide pretty much a neutral signal. They simply display a pattern in which buyers and sellers are unsure of where the stock price should go until the price breaks in a certain direction, either upwards or downwards out of the pattern. But sometimes it will continue sideways, but very, very rarely. Now, before we start trading these patterns, there are a few key things you need to know. First and foremost, you must learn how to recognize highs and lows. These are pretty much the building blocks of all patterns. Using a sketching tool to outline the charts will clearly show you the highs and lows, and is my preferred method for beginners when trying to find patterns. Following that are the trend lines. To make trading easier, trend lines are used to outline the pattern and show you the prevailing trend. To create trend lines, just connect the highs that you previously circled together, followed by the lows. As you can see, this clearly defines the pattern shape. And before you go any further, keep in mind that there are several other types of trend lines to choose from, including curved trend lines. If you're not still sure what I'm talking about, check out my prior video on trend lines. Now finally, we have volume, which is one of the strongest indicators for confirming patterns and boosting your trade success. And just like how candlesticks inform chart patterns, so can volume bars. And usually every chart pattern has a volume bar pattern connected with it, which will be explained in each lesson. Now, I know this might sound a bit confusing, and don't worry if it does, it did to me when I first started out. Each lesson will take you step by step, giving you clear examples of how to trade each pattern with identification guidelines, price targets, stop losses, as well as statistics for each pattern. So if you're ready, let's hop into this series. We'll be learning about 60 plus patterns.